The purpose of this video is to give you a brief understanding about what risk and uncertainty is, what is a peril, what is a hazard, and what are the different classifications of risks. We begin with risks and uncertainty. Risk. What is a risk? A risk is basically an unplanned event that may affect one or some of our project objectives if it occurs. The risk can also be positive or it can be negative. It can affect your project positively or negatively. There are separate risk response strategies for negatives and positives. The objectives of a negative risk response strategy is to minimize the impact of the probability of loss, while the objective of a positive risk response strategy is to maximize the chance or impact. Now, there are also two types of risks. These risks are known and unknown risks. Known risks are identified during the risk processes, and unknown risks are those that we can't identify. Now, a contingency plan is made for known risks, and you will use the contingency reserve to manage them. On the other hand, unknown risks are managed through a workaround using the management reserve. Next, what is uncertainty? Uncertainty is a lack of complete certainty. In uncertainty, the outcome of any event is entirely unknown and it cannot be measured or guessed. You don't have any background information on the event. Uncertainty is not an unknown risk. In uncertainty, you completely lack the background information of an event, even though it has been identified. In case of an unknown risk, although you have the background information, you missed it during the identification process. In short, risk describes a situation in which there is a chance of loss or damage. Conversely, uncertainty refers to a condition where you're not sure about the future outcomes. A few comparisons between risks and uncertainty are: in risk, the possibility of a future outcome can be predicted, while in uncertainty it can't be. Risks can be managed, while uncertainty is uncontrollable. Risks can be measured and quantified, while uncertainty cannot. Next, we have perils and hazards. Peril is the cause of a loss, for example, wind, theft, etc. Whereas hazard is a condition that may create or increase the chance of a loss arising from a given peril or under a given condition. Now, there are two types of hazards. Physical hazards. Physical hazards refers to actions, behaviors, or physical conditions that constitute a hazard. Smoking is also considered a physical hazard in regard to health insurance because it increases the probability of severe illness. Now, the next is moral hazards. Moral hazards are those hazards that result from conditions or circumstances that tend to lead people or institutions to adopt a more careless or reckless attitude and exercise less caution to prevent injury just because they have an insurance to back them up. Now, for my last topic, which is classification of risks. Risks can be broadly classified into three categories: financial and non-financial risks. Now, what are financial and non-financial risks? Financial risks are those risks whose outcomes can be measured in monetary terms, and non-financial risks are basically risks whose outcomes cannot be measured in non-monetary terms. For example, theft of property, including cars or motorcycles, can be considered a financial risk. Next, we have fundamental and particular risks. Fundamental risks are basically those risks that arise mostly from nature and causes beyond of control. Such losses may be left by a large number of people, maybe felt by a large number of people, and they occur in huge magnitudes. Whereas pure risk is a type of risk whose outcome leads to only a loss or a break-even situation. There is no possibility of gaining from a pure risk, and it is always unfavorable. The third and the last category is speculative risk. Speculative risks are those risks where there is a possibility of gain. The risk is taken with the intent to make a profit, but the outcome may or may not be favorable. The most common type of speculating risk is investing in the stock market. So basically, these are the three subheads of the classification of risk.
Now we will look at asymmetric information, which is when one has more material knowledge than the other. Also, the two problems, that is moral hazard and adverse selection, will be discussed. Asymmetric information occurs when one party has more material knowledge than the other in an economic transaction. It is also known as market failure. It is usually seen when the seller of a commodity possesses more great material knowledge than the buyer. One example of asymmetric information can be seen in the financial markets. Here, the borrower has more information about his state of borrowing than the lender. He may have access to information like the credit rating, but does not possess much information as the borrower does. The most popular example is The Market for Lemons by George Akerlof. A lemon is a used or defective car, and a peach is a good car. The average price is what the consumer is willing to pay. Also, the buyer cannot distinguish between these two cars, so the seller sells the lemon for this price and leaves the markets once they hold only peaches. And because of this, the market is filled with lemons. Asymmetric information generally leads to two problems, that is adverse selection and moral hazard. Adverse selection is a situation in which one party has more accurate and different information than the other party. It occurs when asymmetric information is exploited. Insurance companies face a great deal of risk from adverse selection. It can happen when they fail to identify a risk at the time of the policy is made, and it could also lead to huge cost. Consider an example, a person. He takes a life insurance policy for himself, and at the time of taking it, he does not disclose the fact that he is an avid mountain climber or skier, or if his job possesses any threat. He faces more risk in terms of injury and death as compared to a normal person. So if the average cost is charged, then the firm could be bearing more costs than expected. In order to reduce such risk, the companies must have proper screening procedures of the risk, and also they should place controls on the claims by them. Moral hazard is a situation in where a person gets involved in a risky situation knowing that it is protected against the risk and that the other party will incur the cost. This decision is based on the fact that the highest benefit is for themselves. The difference from adverse selection is that in moral hazard there is a change in the behavior of one after the policy, whereas in adverse selection one person has more different and accurate information than the other one. For example, consider a person who, before obtaining a home insurance, was very careful and took all the precautions to avoid burglary or any risk to the house, like setting up burglar alarms and cameras. But once he obtained the insurance, he does not have the same level of caution as he had before. He was of the notion that the insurance company would bear any cost that would incur upon the house. Medical insurance companies also face such a situation when they are not willing to offer the complete insurance because they feel that the doctors may have an incentive to overprescribe the treatment, or that the individual himself may go for a more elaborate treatment even though it is not required. Hence, moral hazards can cause huge losses to an insurance firm. To avoid this and prevent moral hazards, insurance could make sure to get as much information as possible from the insured. This will help in reducing the risk as well as cost. Also, if any instances of moral hazard are found, then it could be penalized. Regular checks could also be conducted to ensure that there is no asymmetry of information.
So I'm going to be talking about the 2007-8 financial crisis. So the 2007-8 financial crisis was basically a global economic turndown that pretty much ruined the financial as well as the banking sector of the United States of America as well as parts of Western Europe. And it was due to something known as the subprime mortgage crisis. So basically, before the 2000s, banks and lenders were not willing to lend loans or mortgages to people that had unsteady jobs or bad credit ratings, as there was a good chance that they would default on the loan. But this attitude changed after the 2000s. So in 2000, investors in the US as well as abroad looking for low risk, high return investments began pouring large amounts of money into the US housing market as they felt that they could get a higher interest rate from the housing market than by investing in treasury bonds, etc. However, they didn't just want to buy individual mortgages as it was quite a hassle to deal with individuals. So rather, they purchased something known as mortgage-backed securities, which was basically like thousands of individual mortgages that were bundled up together. And investors, as they started to buy more and more of these mortgage-backed securities, the prices of houses in the US shot up a lot, because of which lenders felt that even if borrowers did default on the mortgage or loan, they could always just sell the house for a higher price in the market and get the cash back. Moreover, a lot of credit agencies felt these securities were quite a safe bet and gave them a AAA rating. Investors were quite desperate to buy more and more of these securities, because of which lenders tried their best to create more of these mortgages. So they started lending money to people that didn't have very good credit or they had very unsteady jobs. This was known as the subprime mortgage. And as the investors and traders started throwing more and more money into the US housing markets, the prices of these houses shot up by quite a lot. And they felt that even if borrowers did default, they could always just sell the house. However, this thinking was quite wrong, because ultimately borrowers were not able to pay for the expensive houses and they kept defaulting on their payments, because of which the price of these houses reduced by quite a lot in the US market. The supply for these houses increased while the demand was quite less, and hence the price fell. This led to more defaults. As this was happening, a large number of financial institutions had already declared bankruptcy, such as the Lehman Brothers. A lot of them needed to be bailed out by the government or they were forced to enter into mergers. The trade and credit market froze, the stock market crashed, and the US economy was suddenly into a recession. Now, the government did a lot to try and improve the situation. They had introduced the TARP program, which is basically the Troubled Assets Relief Program. The Congress had introduced around $800 billion into the economy to try and lift it up from recession. The Congress also introduced the Dodd-Frank law, which allowed the federal government to take control of those banks that were on the verge of bankruptcy, as well as to prevent banks from lending loans to people that were not capable of paying it back. Now, one of the factors that led to this financial crisis was something known as perverse incentives, which was basically those policies that ended up having a negative or opposite effect on the economy. So, like mortgages, a lot of brokers got bonuses for lending out money, because of which it encouraged them to make risky loans, which affected profits. This leads us to moral hazard, which is basically when a person bears more risk than they're supposed to, as they feel they can pass on the risk to somebody else. And so because of this, banks and lenders were willing to lend to subprime borrowers as they planned to sell the mortgages to somebody else. Everyone thought that they could always just pass on the loan or the risk, and hence they wouldn't have to suffer. And this concept kept going on, and banks also knew that they would be bailed out by the government if at all they entered into bankruptcy or financial crisis. And ultimately, this led to the failure of the financial industry, which led to the 2007-8 financial crisis.